Hello friends, welcome to my 10 cents. One of the first lessons that I learned when I became a corporate banker, the first lessons that I learned was no amount of interest can compensate for the principal. What it means is when you are lending money to somebody, never look at interest rates and lend money. If you have two choices, one where a person is borrowing 9% and another where a person is borrowing 12%, never look at the 12% and lend money, because if something were to go wrong, the 3% extra that you get will never cover up for the loss of principal, the money you have lent. So never look at interest rate when you lend money. Look at always the risk first. This is the first lesson I've learned, and this is one lesson that has stayed with me for all these years when I looked at any form of debt investments. Every investor should remember this, but sadly, most people don't even care about this. At least, most investors never cared about it till 2020. If you look at the last 15-20 year history of debt mutual fund investment, right till 19 or even 2020, most people never really cared about credit risk. The only risk that people were actually worried about was interest rate risk. Now, if you're not familiar with what interest rate risk and credit risk, and you need a bit of a refresher for the fundamentals about investing in mutual funds, debt mutual funds I mean, you can watch another video, the link is there in the description, where we have covered the fundamentals of debt mutual funds properly. I would urge you to see that first if you're not clear of some of the concepts like interest rate risk and credit risk. But let's come back. Most of the people for 15-20 years never assumed credit risk is even a reality. Never bothered about something called as a liquidity risk. All debt mutual funds were safe. The only thing you need to worry is the interest rate cycles. Just play safe. If you're taking a larger duration, then that means you can get double-digit profits or double-digit losses. If you want to be safe, stick to the shorter end of the curve, and that is about it. The only thing to worry is interest rate risk. Credit risk, liquidity risk and all really doesn't matter. For the longest of the while, this is what people thought, and that's how they opted. Then comes 2020 April, when Franklin Templeton, which was the poster boy of superb returns in the debt mutual fund space, when many of the debt mutual funds were giving, let's say, 6 or 7% or 8%, Franklin Templeton was able to give another 2 or 3% over and above for a long while from, I guess, 2015 or 16 onwards. In 2020, they decided to shut down 6 of their debt mutual funds, totaling to over 25,000 crores in assets under management. This is what you call as a financial tsunami. It was long in the offing. It was supposed to have happened earlier as well, because the problems had started somewhere in 17 or 18 when a number of the large corporates who had borrowed from banks and debt markets as a mutual fund markets had started defaulting, and some of these fund houses which had a huge exposure to the so-called high yield, high paying corporates were managing their show one way or the other without taking hits. You can see about JP Morgan fund getting affected by Amtech, Taurus fund getting affected by some other default, and so on and so forth. But come April 2020, Franklin Templeton just couldn't manage. They decided to shut down 6 of them. That is the first time when many investors had to sit down and take notice that when you're investing in debt mutual fund, you're not looking at just interest rate risk. You have credit risk and liquidity risk as well. So this trifecta, when it plays out, it can play havoc with your investments. So in my 10 cents, we decided to look at this whole saga of defaults and jot down what are the lessons that we can learn from the credit crisis that happened in 2020, but effectively stretching from 2017-18 to 21-22. So, the first lesson from the credit saga that we can learn. When you look at debt mutual funds and when you invest in any debt scheme, Never chase returns. That can work very well in the case of equity mutual funds, but it will not work in the case of debt mutual funds. Why? When you invest in equity mutual fund, you are buying effectively a share in a company, and your returns in the long term are going to be decided by how well that company does and how much their profit grows and their share price grows. You are a shareholder in the company, indirectly. But when you invest in a debt mutual fund, that mutual fund scheme is effectively investing in the bond of a company, and that bond basically means, very simple, on a fixed date it will continue to pay contracted interest, irrespective of how well or how bad the company does. You get no upside from the growth of the company. You are not buying into the growth of the company. You are a simple lender. And when you look at history of performing very well, when you chase returns in equity mutual fund, you are effectively depending on the fund manager's ability to identify the next higher or better performing companies. But when you chase returns in a debt mutual fund, you are not looking at the fund manager's ability to chase a better quality risk. Then how is he delivering the return? He can deliver the return only by going down the credit chain, because as I've said earlier, all AAA companies will operate in one certain range of pricing. If you are a AAA company and if you pay the best AAA company and the worst AAA company, the difference in the interest that they pay on their borrowing will be mostly plus or minus 1%. So if a fund manager has to deliver a better return, he is not inherently going to find a better company. He will actually find a worser company, because as you go down the curve from AAA to AA to single A, the interest rates start going up. The companies have to pay more for their borrowing. So, in debt mutual funds, never chase returns, because the returns almost always comes at the cost of taking a much higher risk. First lesson. This is a lesson which people conveniently forgot about for 15 years, till 2020. When they realized, no, the return that extra that they're getting is at the cost of a higher risk, and most debt investors are looking for stable and safe home for their money. Whether they like it or not, most people are not prepared to take that kind of a risk with their debt portfolio. So, 1. Never chase returns. What's the second lesson? We went back to the series of events that happened, the credit crisis as we call it, and we decided, how did the credit crisis affect the different fund houses? Have all of them got affected? We went and looked at 10 large defaults that happened in that case. There were more defaults as well, but we picked up 10 of them, as you can see here. And we went through these 10 and we tried to comb through all these 10 defaults and see which fund house has got how much exposure. And the analysis that came up was very interesting. We found that 5 fund houses have reasonably managed to dodge almost practically all of these 10 defaults. The 5 fund houses are HDFC, Axis, IDFC, and to a lesser extent, State Bank of India and ICICI. These 5 mutual fund houses managed to avoid most of these defaults, or even if they got caught, they were just quite less, far and few in some of these defaults. That was startling to me. Out of all the fund houses there, and out of 10 defaults that I've outlined, over a period of 4 years, these 5 guys have managed to demonstrate that they have a better quality of fund selection. Now, it could be because they are a larger powerhouse lenders where they have a better institutional understanding of the credit markets in India, or they have a better talent, or the sheer vintage of being in India for a long time. Whatever the reason may be, these fund houses demonstrated to us that they are what we call safe fund houses. They are able to invest sensibly. This was the second lesson. 1. Don't chase returns. 2. Pick and stick to safe fund houses. 3. Again, when we looked at the series of returns, the series of events, we found out that when credit risk happens, when the investments that you've made as a mutual fund manager starts going bad, you are going to have pressure on your portfolio, because investors who have invested with you will want their money back and there is only so much you can sell, because the investments that have gone bad, in the companies that have defaulted, the bonds of the companies that have defaulted, it is not going to be easy to sell. Often there may not be a buyer there, and you have to effectively sell the good investments that you have made to return money back to your investors, and which basically has two stark impact on your portfolio. One, when you sell your good investments, you must remember that the good investments are effectively paying for the bad investments, because when a company stops paying the loan or the bond and the interest, there is no money coming from the bond. The good investments which are paying the interest on time has to cover up for that. And when you sell that, the overall fund return suffers. And often when too many people of your investors ask money back, there is only so much good investment that you can sell, and sometimes you may even have to shut down your fund. Okay. The liquidity risk, as we call about it. So we figured that the smaller the fund, the greater the risk of it running into a shutdown problem. So if your fund is very large, then it can reasonably well handle a few rotten apples in the portfolio. But compared to that, if you have a smaller fund, then the fund manager's flexibility or headroom is smaller. So the third lesson that we picked from the series of events is, when you are investing in debt mutual funds, stick to large schemes. Larger schemes. As large, the better. Because the larger schemes can handle stress much better. They have the ability to take hits more. So, 3 lessons so far. Don't chase returns, safe fund houses, and large portfolios. 4. If you're building a debt mutual fund investment portfolio, the one question that you should ask yourself is, how many funds should I have in my portfolio? 1, 2, 3, 5, 10, 15. What is the right number? Now, there is no science to it, but I can help give a few pointers. Building on the events that happened that led up to Franklin Templeton shutdown and what transpired after that, one must, as an investor, presume that when you invest in debt mutual fund, there is a possibility of something going wrong, and when things go wrong, on a nightmare worst case basis, the fund manager may shut the redemptions. If he shuts down the redemptions, then your money gets stuck. The fund manager can then return the money to you only by fighting the court cases to recover the money from the companies which has defaulted on the bonds and eventually pay you back. So a shutdown is the worst event that you should be prepared. Now, from that perspective, if you look at it, my understanding and lesson is that pick the number of funds in such a way that your overall portfolio does not get exposed more than 10 or 20% risk. If it is 20%, means you have 5 funds. If it is 10%, it means 10. So if things were to go wrong, even if 1 or 2 funds were to get affected, your portfolio still 80 to 90% portfolio is reasonably well. So if you ask how many funds should I invest in debt mutual funds, how many funds should my debt mutual fund portfolio have, I would say between 5 and 10. A number which you're comfortable, and the cost of that comfort is your administration load goes up because you have no more work to do when you sell, the tax filings, tracking, everything. And you can remember that other than administrative load, this diversification is not going to come at the cost of lower returns. Because remember, as I've told earlier, most of the debt for mutual funds of a certain category give performance in the same range plus or minus 0.5%, worst case 1%. So you add more funds, it's not going to affect your returns. And the last lesson, looking at these 4 lessons and reading about the Franklin Templeton issue and the defaults that happened, it is very easy for one to get a little worried about investing in debt mutual funds. One shouldn't. That is far from the reality. If you look at today the size of debt mutual funds, they are almost 15 lakh crores. In the 15-20 years, if you look at the history of debt mutual funds and mutual funds overall, the issues of mutual fund shutdown and problems are far and few. If you use the lessons that we have outlined here and stick to the safe fund houses and large funds, the chances of getting hit and that impacting your portfolio are mostly should be manageable. if you take at the default, if you look at 15-year history, 1 or 2 year of bad defaults and a few thousand crores lost here and there is still only going to be a very small impact on the overall fund return, perhaps not more than 1 or 2%. And if you're staying invested for a 5-year horizon, that comes with the territory, because debt mutual funds are able to give a superior return, especially on a tax-adjusted basis over fixed deposits. So debt mutual funds should be a very important part of your debt investment strategy, because these funds have demonstrated time and again the ability to deliver good returns. And let us also not forget that even fixed deposits are not safe. We've had a number of people losing their money investing in fixed deposits of cooperative banks. We have seen banks getting shut down and run into problem. So there is nothing called as a 100% safe investment. Every investment has some risk. You just need to be aware of the risk. You have to use the lessons from the defaults that have happened in the history, so that these lessons can bomb-proof your investments and build a stable, safe, secure portfolio. So those are the 5 lessons that we have learned at my 10 cent from the debt crisis that we have seen in the last 5 years. I hope you find these lessons useful to build your portfolio. Related to this, we have also a separate video on the strategies that one can adopt to select the right debt mutual fund. If you've not seen that, I would urge you to watch it. That can further build out a lot of ideas for you to build the right portfolio. It would be useful. The links are there in the description. I hope you've liked the video. Please encourage us with your like and subscribe. I'll see you in the next one.